Recently, we did a video about a fund that produced nearly 20 times the return of the S&P 500 over the last 50 years, and the exceptional portfolio manager who was responsible for a lot of that success. But unfortunately, there are signs that he might retire soon. So that led to the question from Bonanza Time. Do you know of any other funds like Fidelity Contra Fund with an exceptional portfolio manager who's a bit younger and not about to retire? Yes, I do. And that's what we'll be covering in this video. Quick disclaimer, I don't know him personally, so I'm not 100% sure that he's not about to retire early. I'm sure he could if he wanted to, but he's only like 50 years old, so the odds are that he's going to stick around for a while. The challenge with finding a great active manager is, well, there are a few. I'll give you three of them. First of all, there just aren't that many. We all know most active managers don't consistently beat their benchmarks, right? So, challenge number one is that it's kind of like finding a needle in a haystack. Challenge number two is, well, of course, we can easily find active managers who have beaten their benchmark in the past 1, 3, 5, 10 years. It's much harder to find one that can consistently repeat that success over the course of time. Why? Because there are a lot of different factors that drive success against a benchmark in the short term, and some are repeatable, but others are not. If it's just a really aggressive fund and the market has been really strong, then it shouldn't be a surprise that it's beat its benchmark in the past. But the stock market is cyclical, and if it's already been on a really good run and now maybe it's more expensive, it's more likely that a downturn is coming at some point. Is that really when you want to buy a very aggressive fund? Probably not. That doesn't just apply to aggressive versus conservative, it can be any structural difference between a fund and its benchmark that's likely to persist. Always more growth oriented, always more value oriented, always has more small caps, always has more emerging markets, whatever it is. If it structurally has more exposure to whatever has been in favor in the market, then that is not repeatable because markets are cyclical. So whatever has been in favor may not always be in favor. And if you always have more exposure to that, what's going to work out sometimes and not others. So challenge number two is differentiating between luck and skill. That's a big one. Challenge number three is that often when you finally do find a manager with a long enough and strong enough track record that you think he or she might be one of those needles in the haystack that does have skill as opposed to just luck, one or two things end up happening. Either their fund is already too big and it's closed to new investors, or they've reached the end of their career and they're nearing retirement. Will Danoff of Fidelity Contra Fund from our last video falls into the camp of near retirement? Probably. He's in his mid-60s, and they just named two co-portfolio managers to his fund for the first time in 2025. David Giroux of T. Rowe Price, who we're covering in this video, is more in the prime of his career. He has a long and extremely strong track record to the point where I think we can be confident that it wasn't just luck, and, at least based on his age, he's less likely to be on the verge of retirement. He's been with T. Rowe Price, which I consider to be one of the best investment managers in the industry, by the way, for 27 years. He's the head of investment strategy and the CIO, but mostly he's made his name as the portfolio manager of T. Rowe Price Capital Appreciation Strategy. Since he started managing that fund in June 2006, almost 20 years ago, it's been nearly even with the S&P 500. Okay, you're probably thinking, how is that impressive? And the answer is, the fund is only about 60% stocks. Here's what the bond market, represented by BND in green, has done in that time. That's the sandbox he's been playing in with nearly half of his portfolio. Here's what he's done against the Morningstar category, which is made up of similar funds. The percentile rank is 1 to 100, with 1 being the highest. I literally can't emphasize this enough. I have never seen a fund with this consistently strong of a track record ever in my entire career. I would be surprised if there was any other fund in any category in the entire mutual fund or ETF industry that had been in the top third of its category every single year for at least 10 years in a row. In fact, he has literally set the all-time record by beating his Morningstar category 17 years in a row. Unfortunately, if you don't already own this fund, you probably can't buy it. It's closed to new investors. Remember how I said challenge number 3 was that if you find a manager with a good enough and long enough track record, they're often either near retirement or the fund is closed? Well, Will Danoff from Fidelity Contra Fund is near retirement, and this fund is closed. But I have good news. You didn't think I'd leave you with that much of a teaser, did you? Come on. And actually, you know what? No. This isn't good news. This is great news. But before we dive into that, can I ask you for a quick favor? As baffling as it is that there's a portfolio manager out there who's been so incredible, and yet no one else on YouTube is talking about him, it's equally baffling to me that 71% of you who watch this channel regularly still haven't yet subscribed to it. So if you like this channel and you're getting value out of it, and you want to support us, the free and easy way to do that would have a massive impact on our lives and cost you nothing is by simply hitting that subscribe button. And my commitment to you is that if you do that, my partner Cal and I will do everything in our power to help you improve your life by becoming a better investor. Thank you so much. Now, if you just hit that subscribe button, thank you. That's great news for us. And now it's time to pay it back with some great news for you. Yes, the T. Rowe Price Capital Appreciation Mutual Fund is closed to new investors. However, in 2023, T. Rowe Price launched an all-equity version of it, and they did so in a more tax-efficient ETF wrapper, and that you can buy. Allow me to introduce TCAF, the T. Rowe Price Capital Appreciation ETF. If we look at the holdings of the mutual fund on the left and the ETF on the right, we'd see they're pretty well aligned, with 7 out of the top 10 holdings in the fund also being top 10 holdings in ETF. Obviously, the ETF has larger percentages in these holdings since it's 100% stocks instead of about 60. Using Morningstar's similarity score, the stock portions of the portfolios are either 85% or 97% the same, depending on how you measure it. So it's not a direct replica, but you're definitely getting access to David Giroux through this ETF, and it's an all-stock version with a more tax-efficient ETF wrapper. But wait, there's more. It also comes at just 31 basis points, which is less than half of the cost of the investor shares in the mutual fund. There are just 3 possible reasons for caution that I have to bring up, but none of them really concern me that much. The first is in the bottom right. So far, you can see through the first 2 years since inception, TCAF is behind the S&P 500. Why doesn't that concern me? Well, 2 reasons. First, have you seen his long-term track record? Let's not get carried away with a 2-year period. Second of all, he's a contrarian investor. The peak of the market, when everything that's been heavily in favor for a long time is leading the last legs of a rally, is really not the kind of environment that I would expect him to do well in. And that's really when this ETF has trailed. First, in the last few months of the rally at the end of 2024 through the beginning of 2025, it trailed. Then the ETF made up all of that gap between it and SPY in the downturn. And then it since fell behind again during the massive tech-led rally, Mag 7-led rally over the last few months. I'm not particularly surprised by that. If you think tech will just keep rallying forever, you should probably just buy a tech fund. If you don't, then I don't see any reason for concern here. The S&P 500 has reached record concentration levels in a very overcrowded trade. For me, I actually want to see my investment managers leaning the other way in that kind of environment, and I'm more than okay missing out on the last little bit of the rally if it means that they're positioned better for what's likely to come next. So for me, this is not concerning at all. Second, and related, could the mutual fund's excess returns have all been from getting the stock and bond timing right or just picking great bonds, which then, of course, wouldn't apply to this all-stock version? I'd say highly unlikely. Remember, bonds have massively trailed stocks since David Giroux took over the mutual fund. No matter how good of bonds he'd picked, it would have been nearly impossible to make up that gap if his stock selection was subpar. Remember, stocks are around 60% of the portfolio. And on the timing question, he doesn't really shift the stock bond allocation around enough to create that much excess return. It might move around by 10% or so, but it's not like he's going 100% bonds right before a downturn and 100% stocks in the rallies. No, it's much more likely that his stock selection has just been excellent. The third concern, which was my number 1 concern with Fidelity Contra Fund, is that they just added 3 portfolio managers. So does that mean he's about to retire? In this case, no, I don't think so. All 3 of them were associate portfolio managers on the fund since 2023, which is when they launched the ETF, and they were analysts on the fund before that. They've been promoted again, which is likely an indication that they've made valuable contributions and earned more responsibility. I'm not sure what that means as far as the percentage of the fund that they will manage, but it's still being led by David Giroux, and I really don't see any reason to believe that that will change anytime soon. For what it's worth, Morningstar also doesn't think so, and they typically interview the portfolio managers of large funds directly. So it's another good person that I'm happy I agree with. When it comes down to it, TCAF isn't a direct clone of the mutual fund, but it's very close to the equity portion of it. And of course, past results aren't a perfect predictor of the future anyway. What I look for in an active manager is a consistent, repeatable process. How did you do? How did you do it? And can you do it again? How did he do? He literally broke the record for most years consistently beating his peers. How did he do it? Well, it was in a multi-asset strategy, so stocks and bonds, a little bit different than what we have here, but I think we can be fairly confident that a large portion of the excess returns came from his stock selection. Yes, there are some new co-portfolio managers on the team, but they were just promoted from being associate portfolio managers on the team, and they were analysts on the team before that. And they were promoted at a time when they launched an ETF and decided to expand. So that makes sense to me. In the end, nothing is guaranteed, but I would personally feel great about investing with David Giroux through this ETF TCAF, because it seems to be pretty close to the equity portion of his flagship strategy that's now closed to new investors. When you add in the fact that you're getting it in a more tax-efficient structure and at a significantly lower cost, to me, this seems like one of the best U.S. stock funds out there. If you found this video helpful, please do us a solid by leaving us a like on your way out and hit that subscribe button. It really helps us out in the channel, and it might just help you too. Thank you for watching, and we'll look forward to seeing you in the next one.